Welcome to Inside Economics. I'm Mark Sandy, the Chief Economist of Moody's Analytics, and I'm joined by my two co-hosts, Chris Dorides. Chris is the Deputy Chief Economist, and Marissa DiNatale. Marissa manages our global forecast process. Hi, guys. How's it going?
Hi, Mark.
Doing all right.
Yeah.
All right,
Hi,
Mark.
Chris.
Before we begin, I was wondering if I could ask you something, Mark, because I think it's important we get this out of the way here. I know you're a big Phillies fan, so will you be willing to accept the results of the World Series? Should in fact the Astros win more games than the Phillies?
That is a really difficult question to answer, Chris. Yeah. I did take some real satisfaction, though, in the Phillies being able to figure out the signs in that game where they had 5 home runs. I think they figured out the signs between the pitcher and the catcher, unlike the Astros back in the day stealing the signs. I think they've actually, figured it out this time. So some satisfaction in that. But yeah, I mean, the Astros are a great team. Come on.
All right.
Gee whiz, their pitching is unbelievably good. But
all right, I don't need it. I don't need any contested.
What about you? Are you a
World
fan?
Series? I'm a fair weather fan.
Yeah.
I want the Phillies to win because all my neighbors want them to win. But
right.
Yeah.
What about you, Marissa? Are you a Phillies fan?
Not so much anymore. I mean, when I lived there, I was. It's harder out here to follow them. I've actually. You're probably not going to like this. I've actually become something of a Dodgers fan since moving out here.
Oh,
I know. But I am definitely rooting for the Phillies in this World Series. Absolutely.
Yeah. Well, I think all of America is, except for people with.
I would imagine, yeah.
A few miles of Houston. Yeah, I think.
Yep.
Yeah, but it doesn't look good. We're down 3-2, and then the last 2 games are in Houston, right? So it's going to be pretty tough.
That's right.
Yeah. Anyway, but a great question, Chris. Really good question. And I should say we're all out and about. I mean, it's interesting since really over the last 3 months, it feels like we're all back on the road again, traveling. And you can hear I'm away right now, and Marissa's away. And Chris, you've been on the road a lot.
Yeah.
You told me yesterday you were in West Palm Beach.
Down in Florida. The day before that, I was in New York City. So yeah, getting around.
Everyone's very busy. Everybody wants in person. They want to see people.
Absolutely.
Yeah. Well, I've had
Mark and I
fill
saw each other in person the other night.
Oh yeah, that's right.
That's
for the first time in years.
Yeah, and
since
we had a
the
great
pandemic,
dinner.
or even before.
Well, I can't remember last time. Marissa, can you?
Wow.
Last time we saw each other in person?
I mean, it must have been 2019.
Yeah, it must be. Yeah. But
Maybe 2020. Actually, I think I came to Westchester February of 2020. So perhaps then.
Oh, okay.
But yeah,
we had a great dinner with clients in San Francisco, Marissa and I. We had a dinner. I think there was, 12, 15 clients there. And I'll have to say they're pretty lugubrious, meaning pretty pessimistic. Wouldn't you say, Marissa?
They were really pessimistic. Yeah. We asked them what their own, subjective odds of recession were, and with maybe one exception, everybody was like well over 60%.
Yeah.
Somebody was like 85%.
Yeah. I mean, I was the most optimistic. Well, I wasn't the most. There was one other person there that was more optimistic than me, but they were pretty down. I mean, obviously, San Francisco, I think one could argue, is the weakest large metro area economy in the country. Right? It's getting creamed by tech layoffs, and it's the only place where it's the only industry that are really suffering layoffs up to this point.
Well, mortgage.
Housing,
right?
Finance, that's small, but and house prices are down a lot in San Francisco, right? I mean, by our measure, 7-8% already. So I think kind of coloring people's view, but nonetheless, they were pretty pessimistic.
They were pessimistic down in Florida too. Yeah, I'd ask
really?
the same question down there. 80, 90, the 90 to 100% category for probably recession was the most popular. So,
Oh, wow.
Wow.
a lot of, but they're risk managers, right? That's
Oh, I see.
by nature.
Yeah.
They never go
Yeah.
below 50. So
Yeah. Good point. But still, wow.
still, they're convinced next 12 months we're going in.
Going into recession.
Mm.
Huh. Well, let's get down to business then. I mean, today's Jobs Friday. We got the jobs numbers for the month of October. And you want to give us a rundown, Chris? Give us a sense of the numbers?
Yeah, I'd consider this a bit of a cloud employment report. You can see what you want into it. Most overall, good. All right, we added 261,000 jobs to the economy or to the payrolls. Unemployment rate did tick up to 3.7%. Right, so payroll growth is still positive. It's still stronger than what we need for population growth, but it is slowing. Right, so that downward trend, and that you could argue is by Fed design, right? So I don't think the report itself changes policy. I think it's well within what what the Fed's expectations were, or what other investors were expecting. It was stronger than consensus, but I think the consensus range was fairly large. There were some parts of the report that were more or less positive than others, again, depending on what your point of view is. The labor force actually declined by 201,000, right? So, you have an unemployment rate that is going up, maybe for the wrong reasons from that standpoint. The employment to population ratio.
When you say wrong reason, you mean just a weaker job market?
Weaker job. Well, you have people actually stepping out, right?
That's the bad news is good news, though, right?
Yeah, but you could have people coming in and just not finding jobs, right? Or you could have them stepping out, right? So
yeah. But in this case, but we had participation rates decline. The labor force participation in unemployment actually rose, and it goes to decline in household employment in the month. So employment by the household survey measure, that declined.
Correct.
So in most times you'd say, oh, that's bad news. Jobs decline.
Yeah.
But in the current context, you say that's good news, because
then the Fed won't.
It means the labor market's easing, cooling off, and obviously we need that for inflation to come back down. So that feels like bad news is good news.
Exactly. Yeah, exactly.
Okay,
so it depends on your perspective.
Just to clarify.
Yeah. No, thank you. So you also had the employment to population ratio for prime age workers falling to 79.8. And that's the biggest drop since, was it 2017? Right. So again, good news or bad news type of situation there.
No, bad news is good news. I know it's mind numbing. Bad news is good news. So typically, if employment to population is declining, that means there's more slack in the labor market. Typically, that would be, we don't want that. We want a full employment economy. But in the current context, where the labor market's very tight, wage growth is strong, and inflation is high, you go, okay, that bad news typically is now good news. Is that good? I know, very mind numbing.
Yes, indeed. So, and then I think probably perhaps the most important number from the Fed's perspective is actually the wage number, wage growth, and we've mentioned multiple times on the podcast the issues in terms of average hourly earnings and whatnot, but nonetheless, it is a number that folks do focus on, and that actually was up 0.4% on a month-over-month basis. Right, it had been growing at a 0.3%, so that may be a case where good news for the household is actually bad news for the Fed, right? So,
although
on a year-over-year basis, it's yes, correct, 4.7%. So it is coming in on a year-over-year basis, but month-to-month trends, there's lots of movement. You don't want to read too much into them, but nonetheless, it is something to note.
Would you say though, Chris? I mean, just taking a step back from month-to-month movement, it does feel like, and also bringing in all the other wage data that we are employment cost index, everything else we look at, feels like wage growth is topped out. That's what it feels like. It doesn't feel like it's accelerating anymore.
Yeah, I don't think it's accelerating. It might not be going down as fast as we otherwise might like. That's the
Mhm.
That's perhaps the bigger issue here. But yeah, I don't see many signs of it continuing at the pace it was previously. So,
Right.
beyond that, what can I say? There were some revisions for August and September, right? So some movement around. So net, we actually added more jobs than we had previously thought. In terms of the sectors, the wage or the job growth was actually fairly widespread. Leisure hospitality rose by 35K, which is positive, but that industry in particular is still low relative to what was pre-pandemic. So we're still about 1 million or so short relative to February. So we might have expected a little bit more growth there, but nonetheless, it was positive. The only negative that kind of stuck out was warehousing, but I don't think that's terribly surprising in terms of what we're hearing from Amazon and others in terms of the overhiring they may have done previously, and now shedding some jobs given the overstock or the shift in demand really for services versus goods that is going on. So there was a net job loss of about 20,000 in warehousing, but that had been a very strong grower to begin with. So I'm not terribly
Any sector,
worried.
I haven't had a chance to dig deep. Any sector
Yeah.
showing any declines? Any major industry that showed declines in employment, or it's just
That was-
slower job growth?
Correct. The warehousing was really the only one that showed anything of significance in terms of declines. The others were, just not growing as quickly as they had in the past.
Yeah. Okay. Hey, Marissa, anything to add to Chris's précis of the report?
The one thing that stuck out to me in terms of the sectors was construction. It had a very small job gain of 1,000, which is tiny compared to what it had been doing. And there were actually job losses throughout some of those subcomponents of construction, like contractors and residential, non-residential contractors. But I think I agree with the overall take. I mean, it's still a pretty solid report. It was better than people were expecting. I don't really know how much stock or what to make of the household survey side of things, right? Just the big loss in jobs. And actually, if you adjust the household survey to the payroll survey definition and methodology, you would get an even larger loss on the household survey side. So I'm not, that it's a much smaller survey. The sampling error is much, much larger. So it's hard to know if we should, put a lot of stock in that, especially because this is the first month that that's happened. But yeah, I mean, it's still, at least on the payroll side, looks pretty solid, right?
Yeah, one thing that the BLS did mention that I want to call out, because I know you're down in Naples, Florida, is Ian, the hurricane that kind of blew through.
Yeah.
And according to the BLS, it didn't have any impact on the job numbers, or I think that's what they said. BLS said.
Yeah, they did, and we might see it when they release the data for states and metro areas, later. Maybe there's something there. And you do see a little bit of it in the jobless claims data, right? In the initial claims for unemployment insurance, we saw some effect of Ian there. But yeah, I mean, according to BLS, their exact words were, it had no discernible effect on this report.
Interesting. Well, my take is that it definitively shows the labor market is cooling. I mean, if you go back to the beginning of the year,
Yeah,
the economy was creating 600,000 jobs on average per month. This would indicate, if you even with the revisions and everything, it feels like we're at 300K. So a halving of the job growth. Now, still stronger than what
we need.
Fed would like to see.
Yeah.
To make sure that we start generating some labor market slack and allowing wage growth to moderate more sufficiently, which is critical to getting inflation back in. The kind of the rule of thumb is 100K per month. So if you're north of 100K, and we're at 300K, if you're north of 100K, then in typical times, given typical labor force growth, you would see unemployment continue to decline. If you're below 100K, that would be slow enough that you start to see some slack develop, unemployment moving higher. I will say though, that threshold feels a little higher to me right now because underlying labor force growth is feels like it's more like 250K. I mean, if you look at overall labor force growth, even with the decline in labor force participation this month, it's almost 2% year over year. So that's more than double the growth in the labor force typically. And so it feels like we're getting really good, solid labor force growth here. That goes back, if it's not the labor force participation rate, that goes back to working age population. In fact, it goes more specifically to foreign immigration. If you look at the employment of foreign-born workers, that is now rising very rapidly and continue to rise in October. So it feels like the threshold for getting unemployment moving south in the context of current labor force growth is higher. It feels like it's a couple 100,000, maybe 250,000. I think we're pretty close to that if we're not there, already. The other thing I'd say is household employment. And generally, I agree we should be focused on establishment employment. But I would just point out, household employment has gone nowhere since the beginning of the year. It has flatlined. So no growth. That's more volatile because it's based on a smaller survey of households compared to the establishment survey, the survey businesses. So don't want to put too much stock into it, certainly not on a month-to-month basis. But if you take a step back, it really hasn't grown at all, increased at all since the beginning of the year. And that goes to labor demand. So labor supply is pretty good. Labor demand feels like it's weakening. And it does feel like we're starting to see some signs of slack building into the labor market. I mean, the unemployment rate did rise. It's no longer falling, that's for sure.
Right.
It went from 3.5 to 3.7. That may overstate the case, but it's definitely not falling. And employment to population, which you pointed out for prime age workers, that does feel like it's rolled over. It's below that key 80% threshold that we consider, at least historically, to be consistent with full employment. We're now at 79.8, still very high, but definitively, moving down. So, and then the wage growth, yeah, I mean, I don't think it's rolled over, but it's definitely stopped accelerating. We've seen 5% seems to be kind of the ceiling for wage growth. And, if anything, it feels like it's, starting to top out and start to coming down. So I don't know. I look at this and I come away with this, it's not where we need it to be. It's not where the Fed would want it to be. So more rate hikes coming. We need to see more slowing in growth, but it feels like it's moving definitively in the right direction here. And, I wouldn't be surprised if, we have a labor market that's, kind of where the Fed would want it by early next year. At least that's my take on it. So how would you guys, Chris, how would you react to what I just said? I saw you
Yeah.
when I said labor force growth, I surprised you with that statistic. You're going, that can't be right. I saw it on your face, but it is right.
For the household? Yeah. Okay.
No, labor force growth. Take the labor force. That's labor supply. Just look at the year-over-year growth. It's a rock solid 2%. Give or take. It might be, I don't know, 1.9 or whatever, but it's 2%. And typically, in a typical economy, it's no more than 1. And you could argue, given demographics, it should be closer to a 0.5 point.
Right. Right.
So something like that. So we're getting pretty sizable labor force growth. And again, it's not because of participation, because that declined. And it's still more than a point below what was pre-pandemic. It's all about working age population right now, all about foreign immigration. So how would you react? How would you react to?
Well, I guess I come back to the cloud. You kind of see what you want to see in it. So,
do you see something different? I mean, you're right. You see what you want to see, but
it's still quite. It's still quite strong, right, in terms of the payroll growth. And although I don't think this changes the Fed's decision at this point in terms of a 50 basis point hike in December, but it's not helping the case either. I think the preference would have been to something softer here.
Yeah, but here's the other thing. How can we expect a labor market that's rip roaring coming into the year, creating 600,000 jobs a year? It's not gonna, it's just not gonna turn on a dime. So I mean, it's hard to. Yes, we want to slow even further, but is that even realistic or reasonable to think that would be possible?
Well, I think we've been at this for a while, right? We had expected that these mega rate hikes would have had some more pronounced effect by now. I think, right?
No, I'm not. No, I mean, what was the funds rate at the beginning of the year?
Was
Zero, and they were QE. We're not even a year into these rate hikes. When did they start raising rates? It was probably, I think it was March.
Yeah.
Yeah. We're 7 months in. I mean, come on.
But at a very aggressive pace, right?
So, well, yeah, sure. But still 7 months in, 7 months in. You take these, well, here's the other thing. Companies, particularly large companies that employ a lot of people, where the bulk of the labor market is, they don't, what's the word? It's a container ship. It's not a speedboat. It doesn't, you go this way and then you go that way. It takes time to move the ship. So you're telling your HR department at the beginning of the year, let's hire, and we're full bore hire. It's impossible to say now stop hiring and now start laying off workers quickly. It takes time for that to happen. And my sense is, if you're listening, talking to clients and talking to everyone else, that is happening. So we will see this more clearly going forward. Job growth will slow. We're expecting it to happen way too quickly. I mean, 7 months into the rate hikes, I don't know. It just doesn't feel like that's realistic to think we'd be seeing something meaningfully weaker than this, at this point. I don't know, Marissa, what was your, given this conversation, how do you react to it?
Yeah, I mean, I think that, right, we started at 0 on the Fed funds rate. So, I mean, even though they've been aggressive, it's taken time to get to where we are now. And I think now we're really seeing, I mean, even in the housing market, right, that was the most sort of immediate impact of the rate hikes that we saw. And we're still not even really seeing layoffs related to housing yet, at least not significant ones. It seems like we're at an inflection point, I would say, in terms of the labor market. I mean, I think it does seem like wage growth is still solid, but it's not accelerating. We want to see it slow down. I mean, we saw it a little bit with the last release of the employment cost index, right? But I mean, it was a touch slower. And certainly, yeah, job creation, job growth is much slower than it was earlier in the year. But again, still pretty decent, right? In normal times, if you get a gain of 260,000 on the payroll survey, that would be considered a boom report, right, prior to the pandemic. So I think the Fed keeps doing what it said it's going to do, and is going to keep raising, and is going to be aggressive about fighting inflation.
Oh yeah, no argument there. But I'll just keep pushing a little bit more. Going back to labor supply, if it's 2% growth, that's 3 million added to the labor force every year. Divide by 12. What is monthly labor force growth? It's pretty close to what we got for the employment number today, 260,000. Right?
Yeah.
So by that measure, we're there. We're already there. I mean, labor demand is already now on top of labor supply. And given the trend lines, it's very clear labor demand is going to weaken. I don't know what, I'm assuming labor supply continues to remain roughly where it is for a while. And we're going to get higher unemployment. We're going to get lower employment to pop. We're going to get fewer unfilled positions. Here's the other thing. I'm just curious in your reaction. All of this slowdown that we've observed so far is on the hiring side, right? We know layoffs are not up.
Mm-hmm.
Okay?
Right.
We know initial claims for unemployment insurance are, just over 200,000 per week. That is record low. Despite tech layoffs, there's no layoffs in mortgage finance, as you pointed out.
Right.
It's obviously nowhere else. I mean, we're not seeing layoffs yet. We're not even seeing typical layoffs yet. Typical would be UI claims at what? 250,000 per week, something like that.
Yeah.
So all of this slowdown that we've observed is around hiring, and so we know the layoffs are coming. They're definitely coming. You can see, for example, the Challenger numbers, which is announced layoffs, they're starting to come in. I think we got the strongest increase last month, in a long time. And, that's going to start showing up in the data. So it just feels like to me, labor demand, which has been growing much stronger than labor supply, is now pretty much closed the gap, because we've gotten some improvement in supply and demand is definitely weakening, and they're going to cross now that we're just going to see see layoffs start to kick in into and at least normalize to something we've seen historically. Okay, I'll stop again. I'll turn it back to you, Chris. What do you think of that?
How can I dispute it? It's
Okay,
craft such a beautiful story. The only thing is that I worry again that the Fed is going to overstep here, right? It's not fast enough, that inflation doesn't come in fast enough. The wage pressures continue for a while, and they overshoot, right? That's the fear to my mind, right?
Yeah, sure.
You have this nice glide path, and I believe the glide path, right? And if we didn't have this inflation issue in the background, very, very likely that we could land this plane so gently on the tarmac. But I just see an overreaction being a likely scenario.
Well, that's a great point. Okay, so obviously all this conversation is around, can the Fed land the plane on the tarmac? Can it soft land? Actually, that's a bad description, because no one's saying soft landing. Under any scenario, it's going to be an uncomfortable land.
Softish, I guess, is the
just
the
less bad than hard landing, a crash landing. But there's three ways it feels like we can land in recession. One is if the economy doesn't cooperate. If I'm wrong, about the story, as you put it, that I described is incorrect, that we're not going to see the labor market ease sufficiently to bring in wage growth and quell inflation. That's one way, right? Because then at that point, it's not the Fed's making a mistake. They have to get inflation. It's not a mistake. They've got to push us into recession.
It's a reaction.
Yeah. And what I'm arguing is, I don't think that right now, given the data we have to date, it doesn't feel like that's what's going to push us into recession. It feels like the economy is cooperating, with what the Fed wants. But the second way you get into recession is the one you just said. The Fed could make a mistake. They could misinterpret what's going on, or be impatient with what's going on, and then they don't pause at any point. They keep going, and they push the economy into recession. And they didn't have to. Of course, we will never know whether that was a real mistake or not, because you don't know the counterfactual if they actually do that. And then the third way you go into recession is, okay, the economy cooperates, the Fed does everything right, but the economy's still going to be very weak and fragile. It's not going to be soft landing doesn't describe it. It's going to be uncomfortable. And when you're in that situation, you are vulnerable to anything else that can go wrong, even a small thing. And that, that seems very plausible. I don't know how to forecast that, but that's obviously, significant risk. Marissa, what do you think of that frame? What I just said.
Yeah, I think that makes sense. And I mean, the Fed has explicitly talked about this too, right? They have said that they would rather overdo it. They would rather over tighten monetary policy than not go far enough, because if they overdo it, then they can course correct pretty quickly, right? They can lower rates quickly. They could do QE again. I mean, there's a lot of tools that they can use if they overdo it. But if they underdo it, then it's harder to get entrenched inflation under control if they don't go hard enough. So they've explicitly talked about this. I mean, I think they talked about it during, like in the past week, right? So I think that we know that monetary policy happens with a lag. It'll take time to show up, but it seems like it is. I mean, it seems like it's not happening quickly, but it seems like we're at some inflection point here with both inflation and with the job market.
Right.
So I think they stay the course.
Right. Hey, Chris, can I ask you, because I haven't looked, but maybe you have. Feels like the market I saw the stock market. Stock market was up. It looked like bond yields, long-term bond yields were up a little bit as well.
Yeah.
What do you think investors' reaction was to the job numbers? You heard my reaction we heard yours and Marissa's. What do you think the investors' reaction is to the job numbers? How are they interpreting?
I think it's in line with the script that they had in mind in terms of the Fed with a 50 basis point hike in December. I don't think this changes the direction one way or the other, right?
Right.
So
So right now in our forecast for the Fed, we have another 0.5 point, 50 basis point increase in the funds rate when the Fed meets in December, and then another 0.25 point in January when they meet at the end of the month. And that would put the federal funds rate target at 4.5 to 4.3, 4.75, the range for the funds rate. And then we assume that they stop at that point and keep the funds rate at that so-called terminal rate. That's the highest the rate will get during the cycle through 2023, goes into 2024. And by 2024, there's enough evidence that inflation is coming back to the Fed's target that they can slowly allow the funds rate to normalize beginning in the second half of 24, going into 2025. And then in our baseline, that's the baseline, the scenario in the middle of the distribution. The economy comes close to stalling out, but doesn't go into recession. Not an actual, broad-based, persistent decline in economic activity as defined by the Business Cycle Dating Committee of the National Bureau of Economic Research. What are markets saying right now? Where do you have a sense of what investors are saying about the terminal rate and how long the funds rate's going to remain at that terminal rate?
yeah, I looked at it. I looked at the futures earlier. But these things are changing all the time. But a little bit higher, right? So terminal rate right around 4.75% to 5%. I think was the median. Maybe a little bit higher than that even. Maybe the next one up, the 5 to 5.25. So what's that? 2 more rate hikes than what we have.
Adding another 0.5 point to the
correct.
Potential. Yeah, 0.5 point, right.
That's the median. Obviously, there are investors that are on the other side of that, they get even higher, and others that are more in line with us.
Right. Do you know how long the markets are anticipating the rate to stay at that terminal rate? Before the FOMC meeting this week, when they raised rates 0.75 point, I think markets were expecting the funds rate to start coming back down in late 2023. Do you know?
Yep, I'm pulling it up right now. I see that it looks like December they start to
come down,
moderate a bit.
Right? Interesting.
Okay. So
I
think the timing is actually quite similar to what we've or what you've outlined here in terms of holding throughout 2023, and then a little reduction at the end, as the economy is weakening.
Okay. So right now, and I think the markets moved with the meeting, right? When at the Fed meeting, the Fed announced the 75 basis point, 0.75 point hike in the funds rate. In the statement they released with that decision, that actually felt, to my read, a little bit what you might call dovish, that they were going to start they're going to scale back the future rate increases, and it felt consistent with our 4.5 to 4.75. But then when Fed Chair Powell gave his press conference, he sounded a lot more, as they say, hawkish. And certainly that was the market's interpretation. And they marked up the funds rate to terminal rate to 5 to 5.25, another 0.5 point. Is that the correct interpretation of events?
Yeah, that's what I saw. And I think he's fighting a battle with the financial markets more
I agree with you.
Right?
Yeah.
That seems to be his battle all year. No matter how hawkish he seems to come across, it seems that the markets digest that, and then another rally ensues, right? So I think he's having to be even more hawkish than he otherwise would be to make sure that those financial conditions remain tight.
Yeah, it seems to me if I were in his shoes, I'd be doing the same thing, right?
Yeah.
I mean, I don't want the stock market to come back.
Right.
I don't want corporate credit spreads to narrow. I don't want mortgage rates to decline. I'm okay with the strong value of the dollar. I don't want banks to ease up on their underwriting or I want them to be really tight here in their underwriting, to slow credit and slow underwriting. So if I were him, I'd be talking a big game too. And regardless of whether I thought I'd actually get to that interest rate, the 5 to 5.25, it doesn't really matter. I don't care. I don't care about, I'm not worried about my forecast for the federal funds rate, but what I want, the fact that he's talking as tough as he is now reduces the odds that he actually has to raise rates that high in the future because he gets the tightening in financial conditions. That sound right?
Yeah, that's right. He needs to, and I think he is sincere that he will do what it takes. Right?
Yeah.
I don't think he's bluffing here. But yeah, I think it's part of the narrative is to convince everyone, establish that credibility so that he doesn't actually have to use that tool at the end of the day.
Right. Okay. Hey, let's play the statistics game. You guys ready to play?
Sure.
So you ready?
Yep, I'm ready.
Okay, just to summarize the statistics game, we each put forward a statistic. The rest of us try to figure that out through questioning and clues, deductive reasoning. The best statistic is one that's not so easy we get it right away, not so hard that we never get it. And it'd be nice if it's apropos to the topic at hand, in this case, the labor market, or some economic information that came out over the past week since the last time we played the game. Okay, you're up, Marissa. What's your statistic?
29,000.
29,000. Is it in the employment report?
Yes.
Is it in the establishment survey?
Yes.
Is it employment in a sector then?
No.
No.
Oh, it's not an employment in a sector or industry.
Nope.
Is it a change in something?
It not in the way you're thinking about it.
Oh.
Oh.
Ooh.
Wow.
Is it oh my gosh. Okay. Is it? It's not some measure of employment.
It is. It is related to the measure of payroll employment.
Okay.
Is it a difference between
between what?
I got that it's a difference. That's important.
Steam there.
We've established. I'm trying to go through the list of what could be 29,000.
That seems so low for
you.
Yeah.
Shall I give you a hint?
Yeah.
Chris, you talked about this when you gave the thumbnail sketch of the jobs report. You talked about this.
Oh, revisions? Is that the?
Yeah.
Okay.
It's the combined revisions to the August and September employment report. So August was revised down by 23,000, and September was revised up by 52,000 for a net positive 29,000 revision between August and September.
Okay. Nice.
Okay, fair enough. But why did you pick that? Except that you wanted to stump us. Other than that, why did you pick that?
Well, which is a good reason. Which is a good reason.
Which is a good reason.
The stumping. It also just shows more strength in the job market, right? I mean, it's the revisions. Like, yes, August was a downward revision, but September.
Come on, hand me a break.
September being revised up by 52,000 is pretty significant. So you went from a job gain in September that was under 300,000 to one that was over 300,000.
Well, let me ask you
this.
So
you basically had 300,000 for those 2 months.
What is underlying job growth? Abstracting from the revisions up and down in the monthly data, what do you think underlying job growth is now in the establishment survey, the survey of businesses?
Now?
Yeah.
What do I think it is now?
Yeah.
Probably 250-ish.
Oh, really? Okay. How do you get to 250? Because we're at 260, and then before that we were at 350. How do you get to 250?
I'm just thinking of revisions that may be coming, and I think it's a little weaker than what we see now. I mean, now that we've seen this household survey data for the month, and we've seen the unemployment rate go up, I would not be surprised if we get a downward revision to the payroll survey.
Interesting. Interesting.
And, it'll get revised twice too, right? So,
Yeah. You did say something that maybe earlier that I didn't ask for explication, but maybe I should. You said that on the household survey, that's the
Mhm.
survey of households, there is an adjustment that the BLS does to make it apples to apples with the establishment survey, because these are two different ways of measuring, what's going on in the job market. And they're conceptually a little bit different, exactly what's included in each. Did you say that the household employment numbers are actually even the changes are even weaker once you make that adjustment to be apples to apples with the establishment survey? Is that right?
yeah, that is right. I'm trying to find what the number was, but it would have been an even bigger decline in household employment if you do this apples to apples comparison, right? So BLS doesn't publish this in the news release, but they do if you go to their website. They have a section where they make this adjustment. They go through how they adjust it. So, they add in multiple job holders, they take out family workers, they take out the self-employed, those sorts of things. And when you make all of these adjustments to make the concepts the same, yeah, it would have been an even larger decline.
Yeah, and I think, and I don't want to stretch this too far. I don't want to make too big a case, but there has been academic research that shows that big movements in the household survey tend to lead movements in the establishment survey, which is kind of saying the same thing you just said about future job growth, maybe revisions to the establishment survey. Is that right? Do I have that right?
I think I don't know how much research there is out there that's really definitive that shows that household employment might be leading payroll. I haven't, looked at it in a while, and I don't know what's recently out there, but yeah, I have heard that as well.
Okay. All right, Chris, you're up. What's your number?
All right. A little bit of a stumper, I think. 4.63 million.
Say that again?
4.63 million.
Okay. It feels like it's in the employment data.
It is.
Is it in the household survey?
Not exactly, but
oh my gosh,
not exactly.
So is it in the BLS employment report that came out today?
Yes,
okay.
It was released today. Yes.
Is it okay? Is it? I think is it something related to COVID and the impact of COVID?
No.
Is it related to? There are a lot of people who are out sick. That can't be it. That was too high. It's too many people.
If I told you it came from it's from the current population survey.
Okay.
CPS.
Does that help you? Okay.
Yeah, but I asked that and you said not exactly. You said
that's the household survey. CPS, isn't that the household survey? CPS? Yeah. Current population survey. As opposed to the CES, the current what's the CES? Current
current employment survey.
Current employment survey.
Yeah.
Right. Okay, so
is
it's
it the number of? Is it the number of people? Does it have something to do with category? Does it have something to do with unemployment?
Does it have something to do with unemployed?
Yes, the unemployed.
No, well.
You're really hesitating on this?
It is.
This is really weird.
They are. I don't want to give it away.
Say what the number was again?
4.63 million. There are people who are not employed. How about that?
Say that again.
People who are not employed, or who were not employed.
Is it something like the number of people that are not in the labor force but who want a job?
Well, so close. I'll give it to you. They're not
discouraged
in the labor force.
Workers.
What's that?
Marginally attached.
No. No, you're very close, Mark. It's people who were not in the labor force last month who became employed this month.
Oh, okay. Well, that was different than I was thinking. Yeah. So Okay, that's interesting. Okay.
It is interesting, right? So it's large. It's larger than the number of people who go from being unemployed to employed, which is about 1.5 million. So it's a significant chunk, and I wanted to highlight it not because it changed all that much, but just to demonstrate how difficult it is to actually measure the labor market, because you have these fairly sizable group of people who just, is not actively looking for work. They're not in the labor force, and then the next month they are, right? So they transition directly.
Well, that brings up an interesting point. I mean, one of the reasons for lower participation is a low level of number of retirees coming back into the workforce. So interestingly enough, when the pandemic hit, it wasn't, we didn't see a lot more people retire than typical, maybe a little bit more early on, but that didn't stand out. What stood out was the number of people who have retired that actually come back to work, which is actually quite considerable in any given month. And that has been very depressed, since the pandemic hit. And goes a long way to explaining some of the shortfall in terms of participation. And I've always thought it was unclear, what's going on there. Some of it might have been stock prices were high, housing values were high, and these folks felt like, well, I don't really need to go back to work. And part of it might have been COVID. I'm a little nervous about going back into the workforce and getting sick. But if those are the explanations, then both of those seem less of a factor today, right? I mean, the stock market is down a lot. Housing values have rolled over. So people surely are feeling less wealthy and maybe starting to feel, oh, maybe I don't have the kind of nest egg I thought I did in retirement. And clearly COVID still out there, but people likely are becoming less nervous about that, given it's less virulent and more people have vaccinations and that kind of thing. So it feels like your statistic kind of highlights that we are starting to see some of those retirees that weren't in the labor, they're not in the labor force, starting to come back into work. Does that resonate with you, Chris? That story?
Yeah, I think that data is also reported by the BLS directly. Right, just in terms of the number of folks in different age cohorts that are rejoining the labor force. But I think that's right, though. I think that the inflationary environment certainly is causing people to rethink, and the market's falling, right? So clearly that is going to motivate more people to return to the labor force who may have retired early. And I also think they're more flexible work arrangements today as well. So it's, you don't have to commit to a full-time job necessarily. You can pick up some gig work. You could probably do some part-time or consulting work, right? So
remote work,
exactly. So there's more flexibility there as well. That should lead to some opportunities.
Right. Well, that was a good statistic. That was a good one. No way we would have gotten that, though. That'd have been pretty amazing.
Well, I didn't give you a really fighting
good
chance
stuff.
with the hints.
Yeah, that was but a very good one. Okay, I'm going to mix it up a little bit. And that's a clue. Okay.
Jolts.
What's that?
Jolts report.
Well, there's a lot in that JOLTS report we didn't talk about, which I'd like to talk about, but no, this is not in the JOLTS report. But I'm going to give it to you. Ready?
Yeah.
6%. 6%.
And it's from the employment report today?
It is not.
It is not.
I'm mixing it up.
It's employment related?
Nope.
Labor market? Okay.
Nope.
It's not 6%. Employment related.
Not employment. 6%.
It is a statistic that came out this week, though. So it's not the topic at hand. Go ahead.
Is it growth in unit labor costs?
No, that's actually pretty interesting. No, unit labor costs being compensation growth less productivity growth, but which is very high because productivity growth has been weak and wage growth strong. But no, that's not it. But that would have been a good one.
Yeah.
I think that was around 6%.
I think it might have been even higher. Yeah, it's around 6. Yeah, but that's not what I had in mind.
Okay, it's not it.
Yeah. What's our other favorite market that we tend to always talk about?
Housing.
The housing market. Okay, that's a big hint. 6% came out this week.
came out this week, or mortgage MBA?
No,
No?
no. Yeah, it's actually
Home ownership vacancy.
exactly. So which vacancy?
I'm trying to remember which one.
Oh.
The rental.
Rental vacancy rate. That is the
There we
rental vacancy rate, 6%.
Wow.
Yeah. Well, okay. Bonus. You tell me, what is the homeowner vacancy rate?
Lower than 6%.
Yes, indeed it
Yes,
is.
I think that's a
Very-
cowbell right there.
It's a cowbell right there.
Thank you.
Yeah. A mini cowbell. No, it's 0.9.
Is it like
0.9.
2?
0.9.
Okay. Yeah. I thought
Yeah,
it was
and
1
the
or
reason
2.
I bring this up is they're both very low. The rental vacancy rate at 6% is well below what I would consider to be the so-called equilibrium vacancy rate. And that's the vacancy rate that's consistent with zero real rent growth. So rent growth that's equal to inflation, zero real rent growth. That vacancy rate 7. So we're below that. So that's a very tight rental market, and we're getting strong rent growth. But it went from 5.6% to 6 in that quarter. In the quarter, it came out. This is data for the third quarter of 2022. It does indicate, as we have been expecting, that the rental market is going to start easing up here because we're getting more supply, because supply chains are easing and units in the pipeline going to completion are starting to get completed, and less demand because of the strong rent growth and the hit to the ability of households to form. So that is a good sign, in the sense that, again, in the spirit of bad news is good news. Vacancy rate is up, but that suggests that we're much more likely to see more moderate rent growth going forward, and that's obviously very critical to getting the cost of housing, the growth in the cost of housing down, and getting inflation back down to something that's supposed to target. The 0.9, that is the homeowner vacancy rate. That too is very low. I think the equilibrium homeowner vacancy rate is probably 1.3, 1.4. So it's still a tight single family market, no doubt. But that's up from where it was, and it was at a record low in the previous quarter. So the good news, the bad news, which is good news, is it feels like the housing market, which has been incredibly tight in generating these very strong rent gains, which is adding to the inflationary pressures, is starting to move in the right direction in terms of getting those inflation, getting rent growth to slow, and getting inflation back to something that we can feel more comfortable. What do you think?
That is good news.
Good. Okay.
That's good news.
Okay,
Well,
very
in the
good.
sense of
Yeah.
the problem is
same
the
spirit.
lags, right?
Yeah.
The lags are an issue, right? Inflation's
Okay,
still
well,
going to be high.
I think this is going to be a shorter podcast because, as I said, we're all kind of out there running around, traveling a little bit. But let me let's end the conversation like we've ended it a number of times since the beginning of the year, and that is, what does this all mean for recession in the coming year? So what is your probability of recession beginning at some point in the next, well, let's just say through the end of 2023, a little over through the coming year? And what is it today, and how has that changed? So Marissa, how do you handicap things?
I'm at 60%. And actually, I've come down a little bit on that, I think, in the last few months. Mostly because, like I said, I kind of feel like we're at an inflection and we're starting to see the results of monetary policy cooling things down, but not totally crashing it. So I feel, and inflation expectations are well tethered. Yeah, so I'm at 60.
Okay, so you said it's come down. So you mean you were at what, 65 or 70?
I think my high point was like 65, 66 a few months ago.
Oh, so you're coming back in. So like everyone in the world is becoming more pessimistic.
Yeah.
You're becoming less pessimistic.
Mm-hmm.
Oh, interesting.
You've had an effect on her, Mark.
Yeah.
You've had an effect.
Oh, yeah. Finally, I've had an effect on somebody. No one's listening to me. And the reason you say this is because you're, to paraphrase what you said, you're now seeing evidence that the rate hikes are having an impact. Growth is slowing, which is necessary to get inflation back down and avoid a recession. That's what you're starting to finally see it. That's making you feel a little bit more optimistic.
Yeah, and I feel like it is going kind of to script, the Fed script, right? There is, of course, as we talked about earlier, there is, at least we're expecting 3 more rate hikes through the end of January. So there's a possibility that it could be overdone. I mean, there is a possibility that they, depending on what the data look like, that they do send the economy into a recession, or they have to send the economy into a recession in order to get inflation under control. So I still think that's a big risk, which is why I'm at 60%. But so far, I think it's going the way they want it to go.
Yeah. Okay. I hear you. Chris, okay, where are you?
I'm sticking with 70%. I've been there for a while now. So 30% chance that we navigate the narrow path that you've laid out. So I think that's still pretty high.
Can I ask you this? When people put down like these probabilities, they have an arrow pointing up or pointing down to indicate where the risks lie with regard to that probability. So you're at 70. Is the arrow pointing up, more risk that it's going to rise, or pointing down, more risk that it's going to fall?
Up.
Oh, okay.
Up. Yeah.
All right. So you're pessimistic, and the risk is that you're not pessimistic enough.
All right.
Interesting. And you don't take any solace in the numbers that they are not, as Marissa said, they feel like they're sticking to script. That doesn't give you any solace, or it gives you solace, but it doesn't really matter.
They are going to script, but I had already had accounted for that script. It's not deviating from my thinking to this point. I didn't expect a very significant change in terms of the employment picture, for example. So it doesn't really influence anything. But I certainly react to the data. But I'm also looking at oil prices. I'm looking at the yield curve, of course. Right, there are still many factors here that are dangerous in terms of recession risks going forward. Right, and the wages are not coming in as quickly as I think would be necessary for the Fed to really take their foot off the brakes here.
Right. Well, let me ask you this. Going back to that frame I provided on how we get into recession.
Yeah.
One way is the economy doesn't stick to script. It doesn't slow sufficiently. And wage price pressures remain intense, and the Fed appropriately pushes up interest rates and pushes into recession to get rid of that inflation. There is no other way to do it. The economy is not going. And you could argue, that's not an unreasonable scenario, because to go into the job market, it feels like businesses are very reluctant to lay off workers, right?
Mm-hmm.
They know that their number one problem now and for the foreseeable future, through thick and thin, is I can't find workers, because it's just demographics, right? And my sales are off, the economy's soft, and there's a lot of risk, but I'll stop hiring, which is what we're observing, but I'm not going to lay anyone off, because I know I'm going to need them 2 years from now, and I don't want to getting them back going to be very difficult. Therefore,
especially given the pandemic, right? This is what
right. And they don't lay off workers, and therefore the Fed says, "Oh my gosh, I got to completely crush this psychology, and I got to raise interest rates." So that's one way we get into recession. The second way, again, is the economy is cooperating, but the Fed misjudges and keeps on raising interest rates, doesn't pause, and pushes us in, or just makes a mistake. It's hard we'll never be able to prove it, because you don't know what the counterfactual is, but they make a mistake. And the third is everything sticks roughly to script. We're very weak, and then some shock comes along oil prices go back over 100, because the EU botched its implementation of sanctions or something. I'm just making that
Right.
up.
Yep.
Or OPEC says, I'm going to cut another 2 million barrels from my production quotas, that kind of thing. So what I heard you say is, you don't think the reason we go into recession is for the first reason, that the economy doesn't cooperate. It could be the case, but that's not the reason why you're saying this. Your probabilities of recession are so high. You're saying my probabilities of recession are so high because of the other two factors. The Fed makes a mistake, and or we get hit by a shock. Is that, am I saying that right?
Possible. I guess it depends where you put the investor community, right? If indeed the financial markets, investors are not cooperating, they're not tightening the financial conditions, they keep rallying, right? Do you consider that the economy not cooperating and therefore the Fed has to be more aggressive? Or is that
that's tertiary? At the end of the day, it's the economy that matters. What happens with financial conditions doesn't, that's a driver of whether the economy is cooperating. So under the first scenario, financial conditions are sufficiently tight that the economy slows in a way that inflation is going to go back to the Fed's target in a timely way.
Okay, so you would throw that into the third category. If investors just, throw carrots to the wind and they just are fighting the Fed at every instance, and the Fed really has
the economy doesn't cooperate, doesn't slow. That's
Correct.
number one. The economy doesn't cooperate.
Okay, I guess it's the combination of both then.
Well, no, number three is a shock. It's a negative shock.
Yeah, but I guess you're saying the investors are not part of the shock either.
They could be.
If the financial
market sold off 40% for whatever reason, that could be, but usually there's a reason for that. There's a shock,
No, I'm saying the opposite. Right? We've been talking about the need for financial conditions to come in, and if they don't, right, the Fed is going to have to come in harder, right?
Yeah, but that means the economy is not slowing sufficiently because financial conditions are too easy. The only reason why it matters is because it matters what it means for the real economy.
Correct. Okay.
Yeah. So it's all part of number one. I mean, it doesn't matter.
Okay, it is part of the number one. Okay.
Yeah, sure. I mean, the stock market can go up and down all around. Who cares in the context of what it means, unless for inflation, unless it's influencing the economic conditions.
Yeah, but it's not just the stock market, right? It's lending conditions are also easing, right? That's what I'm saying, right? If the rest of the economy reads the situation incorrectly and starts easing, right, loosening up, and the Fed is going to have to come in much more harshly.
Because why?
Right, because it's all psychological, right?
No, but why? I mean, so suppose the stock market rose 30% tomorrow. Why did the Fed have to respond to that? Why?
Oh, because
the
other
economy
conditions
is not
are
going
easing.
to respond. The economy is going to not weaken, right?
Oh, but
I'm
presuming that they're rallying
monetary policy because of what it means for the economy, right?
Correct, but so lending standards are easing, right? There's loosening going on. In the economy, that's going to create an inflationary pressures. It's going to add to it, right?
Why?
Why is it adding to inflationary pressures?
Why?
It's increasing
Stronger
demand.
Economic growth, right?
Correct.
Okay, so the economy is not cooperating. Right? I mean, financial conditions only matter for monetary policy in that they're not weighing on the economic growth. The economy is not cooperating with the Fed's. What the Fed needs for it to happen, right? I mean, financial conditions by themselves don't matter. What really matters is the economy, jobs, wage growth, inflation, right? The financial market,
but those all respond to the financial conditions, right? We just established that. If lending standards are easing, if we're putting more impetus into the economy, right? There's going to be faster growth. There's going to be higher.
Yeah, but okay. Maybe we're just talking over each other. Okay. I mean, at the end of the day, the reason we go into recession on number one is because the economy doesn't slow sufficiently for whatever reason, financial conditions, whatever it doesn't matter.
Okay.
But the economy doesn't slow sufficiently to bring in wage growth and inflation. That's number one. But you're saying that you don't think that's the case. That's not the reason why we go into into. I have a reason to press this because I have actually a question I want to ask you.
Okay.
But I'm just trying to understand, your thinking around this.
I don't
So
think it's the main reason. I think it is a potential reason, though, right?
Okay,
There's
yeah.
that psychological piece of it that
But you're saying the
causes
reason why
businesses to expand.
the more likely reason we go into recession is not because the economy doesn't cooperate. It's because the Fed misjudges what's going on, or that we get shocked, we get hit by another shock.
Yeah, I would say it's most likely another shock. They could certainly be related, though, right?
Yeah. Okay.
One
So
could cause the other.
okay. So this is the reason why I'm pressing you.
All right.
And it gets down to the forecast. The forecast philosophy. How do you, if you believe, if your thinking is we're going to go into recession because we get a shock, another shock, how do you bring that into a baseline forecast? What do I do with that? I mean, am I just assuming a shock occurs at some point in time and it's big enough that it's going to push us into recession? How do I actually make that work operationally in terms of producing a forecast?
Yeah, so I'm submitting that the economy is in a very vulnerable, weak position. It's extremely sensitive to any type of shock. I don't know exactly what that shock may be, but the probability is pretty high we'll get some type of shock, right?
Yeah.
Most likely a supply shock of some sort. I can put that into the assumptions, right? I'm going to have to choose something at the end of the day. So I'll choose an energy price shock here.
Yeah.
That would ultimately tip us in, right?
Okay, so what do I say? That's going to happen in the second quarter, the third quarter, fourth quarter? What do I do with that? I mean, I'm just making some kind of assumption around that there's some event that I don't know what it is exactly, but it will happen, and therefore we're going into recession.
Yes, that's right.
So I'm going to make something. You're like, well, how, in the case of an oil shock, what would you say that would generate a recession in 2023, and when would it generate it?
Oh, so we go through the winter. I think I've mentioned this before. Europe makes it through. They're trying to refill the tanks come spring and summer. Ukraine conflict is continuing. Oil prices, gas prices, energy prices go up once again. And that's sufficient, given the vulnerability in the economy, to tip us into recession, right? Combined with the fact that we will have also increased the Fed funds rate, right?
And you would
slow
make that
down
your
the
baseline
economy.
forecast. That would be your baseline forecast. You would say that's what's going to happen, and we're going to have that kind of a shock, and that's what's going to push us into recession in the second quarter of next year. You would make that your baseline.
Yeah, if pressed to say what specific event, yeah, that's what.
No. Okay, but here we have a forecast.
Correct.
We have a baseline forecast, and now, Chris, it's your job. You are now.
Yeah.
You would do that. You would say, okay, we're going to have an oil price shock in the second quarter that would be sufficient to push the economy into recession, and you would have that as your baseline forecast.
That's my most likely.
Okay, I'm just saying, but that's what you would do. You would actually have a forecast baseline that has a recession beginning in the second quarter of next year because of an oil price shock.
Yeah, your point is that there must be a narrative that.
No, I'm just saying.
Right?
It's because I don't know what the narrative is, and I'm. You're saying there's going to be some kind of other shock. You're forecasting another shock, or maybe it's something like it doesn't really matter. It's going to be. The economy is going to be so fragile. At the end of the day, it doesn't really matter. And and right now, the maximum vulnerability is going to be in the middle of next year. So whatever it is, it doesn't matter. That's when we're going in.
That's what I originally was saying. Yes,
okay.
But you're not satisfied with that. You want something,
No.
I understand that you need to make it. It's an actual forecast. It has numbers in it, right? You have to make something.
Yeah,
you have to make it work, right?
So you have to make it. Well, and also it's very explicit, because now we're going to say oil prices jump, and it has very different implications for, different industries, different regions. And, we're saying this is how we get into recession, which, feels like a difficult thing to do. You see what I'm saying?
Yeah, but I think of course I see what you're saying. All right. You have to, but there are risks on the other side as well. To assume, if you do believe that the economy is vulnerable to shock, and that the likelihood of, I'm saying that the probability of some shock is significantly high, that it warrants being included in the baseline.
And I totally get that. I totally get it. I totally get it. Except is
if you
the
don't put it
reality
in,
is you got to pick a shock and you got to put it into the forecast. And you almost know by definition that that's going to be wrong. It maybe it's the highest probability, but it could be a gazillion other shocks that come along. That it could be anything. But
it could, but I think if I'm thinking about the end user of the forecast, why are they consuming this?
Yeah,
what are they doing
right.
with it? Right? They're trying to forecast some type of something else, right? A portfolio of loans, performance, or sales, revenues, what have you, right? To exclude that possibility that there will be a shock, a recessionary type of event, right? I think you're biasing in the other direction, or you're certainly running the risk that you're not putting enough.
It's just that I feel it just feels I'm uncomfortable forecasting a shock.
I can sense that.
Forecasting a shock.
I can sense that.
By definition, a shock is like pretty hard to forecast. Maybe you can't forecast it. You see what I'm saying? But I hear you. It's a very
we have our in all fairness, our alternative scenarios do have shocks in them, right?
Oh no, that I get.
Right. So we do forecast shocks.
Fine.
We do forecast shocks in other scenarios.
Yeah.
You're just saying the baseline, you're not willing,
yeah.
right?
All right. Okay. All right. We're gonna great discussion, but you see it's mind numbing how difficult this is. To go down the path of forecasting recession based on a shock. Now, if you had said to me the reason we go into recession is because the economy doesn't cooperate, that I get. That's pretty straightforward. But a Fed mistake, that's pretty hard to do, and a shock is pretty hard to do. But nonetheless, a very good discussion. So I'm at 50%, and I was at 55. I'm actually growing more optimistic too, and I do agree with Marissa. It does feel like we've been kind of forecasting the script, but now it feels like the script is actually unfolding, and it feels pretty much to script to me. This is what I would have expected, if you wanted a soft landing. Again, that's not the right word, but if you wanted a non-recessionary forecast. But obviously the risks are very high because we could suffer a shock. And the Fed could make a mistake because they've obviously made mistakes. But anyway, okay. I thought this was going to be short.
Oh,
no, go ahead.
So inflation remains high, right? In the first, for whatever reason, right? I won't even give. If you want a reason, I'll give it to you, right? So mistake. I agree with you. Saying mistake seems as though we are, really accusing the Fed of negligence, right? If they're reacting to persistently high inflation, right, for whatever reason, right, that's not a mistake per se. That's the right response. You see that as a low probability type of event, though, that by your forecast, inflation will be coming down significantly. That the Fed will feel comfortable not having to hike once again.
Yeah, we got to be humble. This is not easy. And in fact, when I talk about the economy avoiding recession, I say recession risks are uncomfortably high. And the only way we're going to avoid recession is if we have a little bit of luck, meaning no shocks and some debt policy making, no mistakes.
So you are incorporating it into the forecast. You are incorporating a
not only because I can't
negative
incorporate a shock and I can't incorporate a Fed mistake. I don't know how to do that. But
implicitly you are. You're assuming there is, a little bit of luck means no shock. Right?
Yeah, no shock. Because to say that there's going to be a shock seems, first of all, very hard to do. Say there is a shock, and then the second thing you have to ask yourself, well, what kind of shock? What is it exactly? Because that has very different implications for your baseline forecast, depending on
when is it?
What's that, Marissa?
And also, when does it happen? Right?
Yeah, and when does it happen?
You're
right.
kind of just picking a date.
Yeah, but on the other hand,
it argues for more scenarios.
No.
You can see I'm being tortured here. I'm being tortured. This is torturous. Yeah, but anyway.
The problem
Okay,
is the risks are asymmetric, right?
that's true too. The risks are
Very.
asymmetric. Absolutely agree. Yeah, absolutely agree. They're asymmetric. Yeah, but again, you got to pick a baseline forecast.
Yeah.
Anyway,
It also
I-
depends on what are you using this forecast for, right?
yeah, we
you-
flogged this to death. We'll come back
Yeah,
to it. I'm
yeah,
tired.
we will.
Yeah,
We will.
I'm tired.
Okay.
Okay. I thought this was going to be a short podcast, but it turned out to be a long one. Hopefully people find this. Do you think, I hope they find this interesting because I don't know if it's too deep into the weeds, but
Our bickering is is entertaining, I guess.
oh, definitely entertaining. Yeah. Okay. Anything else? Last words of wisdom? Okay. Marissa, thanks for joining. I know a little bit more difficult for you on the
Oh,
road.
sure. Yeah, no problem. No
Yeah, I
problem.
appreciate that. With that, we are going to call it a podcast. Talk to you next week. Thank you.